Welcome to everything you need to know about finance. Today we're diving deep into the S&P 500. We've got a stack of articles and research here.
Yeah, we're looking at its recent, wild ride, and also taking a close look at the big three ETFs that track it: SPY, VOO, and IVV.
Exactly. Our goal is to unpack all this information, pull out the key facts, the interesting bits.
It can really help you understand what's been going on, and maybe more importantly, how these huge funds actually differ. There's been a lot of movement there.
Absolutely. And just a quick reminder before we jump in, this is purely informational. We're just exploring the data and analysis from our sources. This isn't financial advice, okay? Just helping you get informed.
Right. Definitely not advice.
Oh.
So with that said, let's get into that S&P 500 turbulence. The sources point to some really dramatic moves after a tariff announcement back on April 2nd.
Dramatic is maybe an understatement. The index apparently dropped over 10% in just 2 days.
Yeah, 2 trading days. And the scale, wow, nearly $5 trillion in market value gone.
$5 trillion?
Yep. And the sources say that's the biggest 2-day slide since March 2020.
Right back at the start of the pandemic market shock. That really puts it in perspective.
It does. And the volatility within the day was also pretty extreme. One source mentioned a swing, the widest percentage swing since the 2010 flash crash.
The flash crash. Gosh, I remember that. So what were the numbers on that swing?
Okay, let's see. The high was cited as 5,246.57, and the low hit 4,835.04.
Wow.
Relative to the close that day, 5,062.25, that's an 8.13% swing in one day.
Incredible. It closed down just 0.2% one day, then plunged intraday by how much?
The material says up to 8.6% intraday, just a massive sudden drop.
So all this pushed the index back to levels from about a year ago.
Pretty much, yeah. And the reason, according to the analysis, seems to be these widespread worries about what the tariffs mean for the U.S. and the global economy.
Okay, but there's an interesting flip side to this pullback mentioned in the sources, right? Valuations.
Exactly, sort of ease the pressure there. One source, using FactSet data, noted the forward PE ratio, price to earnings.
Yeah.
It dropped from 22.2 in February down to 19.4.
19.4. Okay, how does that compare historically? Is that high, low?
Well, it puts it below the 5-year average, which is 19.9, and closer to the 10-year average of 18.3.
So, more reasonable territory.
Kind of. The analysis points out it's not exactly cheap, but it is back in that 18 to 20 PE range.
And that range is significant because
historically, the sources suggest that rain hasn't usually led to big losses over the next year. More like flat returns.
Ah, okay. So less fear of a major correction from those levels, perhaps.
That seems to be the implication. More attractive than the peak valuations, anyway.
And this shift in valuation, this seems to be the trigger for the next part of the story. Investors apparently started flocking to S&P 500 ETFs.
That's what the material indicates, yeah. This influx of cash has really intensified the competition among the biggest S&P 500 ETFs.
Right, which brings us neatly to this race for ETF supremacy. The three main players our sources focus on are STDR S&P 500 ETF Trust, that's SPY.
The original.
The OG, yeah. Then iShares Core S&P 500 ETF, IVV, and Vanguard S&P 500 ETF, VOO.
And it's been a real tug-of-war for assets under management, or AUM. It's quite interesting. The sources note that back in mid-February, Vanguard's VOO actually overtook SPY for a bit.
Which was a huge deal, considering SPY was the very first U.S. ETF launched way back in '93.
Right. But then the data shows that in March, BlackRock's IVV also passed SPY.
So SPY, the original giant, got knocked down to third place in terms of AUM.
Exactly. The figures cited put VOO on top with $571.4 billion.
Wow.
Then IVV with $560.4 billion, and SPY holding $544.8 billion.
Yep. $2 billion in 5 days, and get this, $36.8 billion so far this year.
Huge inflows. What about IVV?
Also strong. $3.2 billion in those 5 days, and $24.6 billion year to date.
Okay, so compare that to SPY. Big difference. SPY saw massive outflows. $12.3 billion flowed out in just those 5 days.
Ouch.
And $29.4 billion out year to date. So you can see why the AUM rankings shifted.
Definitely explains the shuffle. So, okay, the big question then is, if they all track the S&P 500, how different can they really be? Are these differences actually significant?
Well, according to the material, yes. There are some key distinctions, even though they seem similar on the surface.
Like the cost. That's usually the first thing people mention.
That's the big one, yeah. The expense ratios. SPY is listed at 0.09%, maybe technically 0.0945% in one source,
Okay.
while VOO and IVV are both significantly cheaper at just 0.03%.
0.03. That's like, what, 67% less than SPY?
Exactly. And you might think, oh, 0.06%, that's tiny.
Right. Doesn't sound like much.
But the sources correctly point out, over time, especially long-term investing, that difference really compounds. Think about a $100,000 investment.
That's $60 a year difference.
Right. Doesn't sound like a lot, but multiply that by 20, 30 years plus market growth. It adds up to real money.
Good point. Okay, what else besides cost? Liquidity comes up a lot.
Yeah, liquidity. SPY is still the undisputed king there. Its average daily trading volume is cited around 51 billion shares.
51 billion.
Compared VOO at about 5.5 billion and IVV at 4.7 billion. So a massive difference.
And what does that mean practically for an investor?
It means SPY usually has incredibly tight bid-ask spreads. The source mentions basically 0.00%.
So the difference between buying and selling price is negligible.
Pretty much. Whereas VOO and IVV might have a spread of 0.01%. It's still tiny, but it's a small fractional cost that SPY traders mostly avoid, especially if you're trading frequently or in large size.
Okay, so cost versus liquidity, starting to see the trade-offs. What about the structure? You mentioned SPY is different.
Right. This is a fundamental one. SPY is a unit investment trust, a UIT.
A UIT, what does that mean?
Well, the sources explain it has certain restrictions. A key one is dividends. It has to hold the dividends it receives from stocks in cash until it pays them out quarterly.
It can't reinvest them.
Nope. Can't reinvest them internally, and it also can't lend out the shares it holds to generate extra income, which some funds do.
Ah, okay. And VOO and IVV are different.
Yeah, they're structured as open-end funds, like most mutual funds and many other ETFs. That structure gives them more flexibility.
So they can reinvest dividends?
They can reinvest them within the fund until the payout date, yeah. And they can also engage in securities lending, which might add a tiny bit of extra return potentially.
Interesting. Does that structure affect taxes too?
It seems so. The sources suggest VOO and IVV tend to be more tax efficient. Their open-end structure allows for something called in-kind creations and redemptions.
In-kind, meaning?
Essentially, large investors can swap blocks of the underlying stocks directly for ETF shares, and vice versa, without much cash changing hands within the fund.
Okay.
This mechanism helps the fund manager minimize realizing capital gains internally, which means potentially fewer taxable distributions passed on to the shareholders. SPY's UIT structure is less flexible in this regard.
Got it. So lower cost, potentially better tax efficiency, dividend reinvestment for VOO and IVV. But SPY has that massive liquidity.
That's a good summary of the key trade-offs. And we should probably mention the managers. State Street runs SPY, Vanguard runs the VOO, and BlackRock runs IVV. All huge established players.
Right, Vanguard especially, with John Bogle basically inventing the index fund concept.
True. But despite all these differences, cost, structure, liquidity, tax stuff, it's crucial to remember the core similarity.
They're all trying to do the same basic job.
Exactly. Passively track the S&P 500 index. Replicate its performance.
Which means their holdings must be almost identical, right?
Remarkably similar. Same stocks, just tiny variations in weightings. The sources confirm the big tech names, Microsoft, Apple, NVIDIA, are consistently the top 3 in all of them.
And the top 10 holdings make up about, what, 30% of the assets for each?
Roughly, yeah, around 30%. There are tiny differences in the exact number of stocks they hold, like 503 for SPY and IVV, 505 for VOO, according to the data.
Minor differences.
Very minor. And how often they report holdings varies slightly too, but the underlying portfolios are virtually the same. Sector diversification is also nearly identical.
And if the holdings are the same, the performance should be very close too.
And it is. The data shows very similar returns over 1, 3, 5, 10 years.
What were those 10-year numbers again?
SPY at 12.72%, VOO 12.82%, IVV also 12.82%.
And the index itself?
The S&P 500 benchmark was 12.86% over that period. So really close. One source did note IVV's returns are listed as being technically the closest to the benchmark.
Okay. And dividends, all paid quarterly.
Yep, all distributed quarterly. And the yields are similar too. SPY around 1.48%, VOO 1.54%, IVV 1.56%, compared to the index at 1.58%.
Pretty close alignment there. The sources also had a note about tax for foreign investors.
Yeah, the standard 30% dividend withholding tax applies, something for non-U.S. investors to be aware of.
Okay, so let's synthesize all this. Based purely on the source material we've discussed, how would someone choose between these three? Which one is better?
Well, better really depends on the investor profile, doesn't it? The synthesis suggests that for most people, investing for the long haul.
Like retirement savers, buy and hold types.
Exactly. For them, VOO and IVV look pretty compelling. The lower expense ratio is a big factor over decades.
Right, that 0.06% difference adds up. Plus the better tax structure and the dividend reinvestment potential.
Those are definite advantages for long-term compounding, according to the analysis.
But what about other types of investors? Traders, maybe?
Yes. If you're someone who trades very frequently, or perhaps you're active in the options market using S&P 500 ETFs.
Then SPY's liquidity becomes the key factor.
Absolutely. That massive volume and tight spread make it the clear choice the sources indicate. It's just easier and often cheaper to get in and out quickly in large size. One source even called it the best option, pun intended.
Huh. Okay, so VOIVV for long-term low-cost accumulators, SPY for active traders and options users.
That seems to be the main takeaway from comparing them based on this material.
And there was one final important point the sources made about just getting started.
Oh yeah, crucial point. While we've dissected these differences, and they do matter depending on your strategy.
For many people, especially new investors.
The difference between choosing VOO or IVV or even SPY is far less important than the act of actually starting to invest in the S&P 500 index itself.
Don't get stuck in analysis paralysis, basically.
Exactly. Getting your money into the market, getting that exposure, that's the most critical first step.
That's a really valuable perspective. Okay, so wrapping up this deep dive. We covered the recent market volatility, the S&P 500's valuation becoming, well, more attractive.
Which fueled that investor rush into index ETFs, leading to that fascinating leadership shuffle between VOO, IVV, and SPY.
We unpacked the key differences: cost, liquidity, structure, taxes, and also the fundamental similarities in tracking the index and performance.
And highlighted how those differences might make one a slightly better fit than another, depending on your specific needs as an investor.
Understanding these details, even for funds tracking the same index, really matters.
It does. It shows how the underlying mechanics can work.
Which leads us perfectly into our final thought for you to chew on, building directly on what we've discussed. Think about how understanding those structural differences, like SPY being a UIT versus VOO and IVV being open-end funds, reveals these subtle but important operational details.
Yeah, like how they handle dividends before payout, or how they manage potential capital gains through those in-kind transfers.
Exactly. These are details that might not jump out from looking at just the holdings or the one-year return, but they can quietly influence your long-term results, especially when you factor in things like costs and taxes over many years.
It's a great reminder that sometimes the plumbing, the structure behind the investment really does matter, even if they look the same on the outside.
Well said. Thanks for joining us for this deep dive.